Hello and welcome, everybody. Welcome to our webinar on advanced digital asset security and custody in financial institutions. What we will be discussing today is a few digital asset security topics, and with us we have some guests from Bank Frick. My name is Piotr Cielas. I'm the VP of Advisory here at Halborn, and today with us we also have Dennis Zanner and Adam Retkis from Bank Frick. Welcome, gentlemen.
Hello, everyone, and thank you, Halborn, for having us on this call, on this webinar.
Hi, everyone.
My name is Dennis. I spent most of the time or part of my career in the financial institution on the buy side. Along the way, I had the chance to dive deep into distributed ledger technologies, not from a concept itself, but from a more practical tool to solve real-world challenges. Today, I'm excited to share some of my knowledge, what I learned over the couple of last years, the opportunities, the challenges, but also how to make DLT work in the financial industry. I'm looking forward to have good conversations with all of you and dive deep into this topic.
Hi, everyone. My name is Adam. I join Dennis and Piotr here in this webinar. I'm a blockchain project manager at Bank Frick, and I usually do trading and crypto regulatory compliance related projects at the bank. So I'm more of the infrastructure guy in the call. So I'm happy to be here, and let's have a very interesting and exciting discussion about these topics.
Thanks, Dennis. Thanks, Adam. Really appreciate the introductions here. What we're going to do today is we're going to cover a few topics on distributed ledger technology, which are going to include network security and digital assets custody. And what's going to follow is I'll welcome Bank Frick to talk a bit about the blockchain initiatives like Pulse Network, their transformation journey around DLT, and also custody. And we'll wrap up our webinar with a short Q&A session from the audience. So please make sure to post your questions on our different streaming channels, and we'll make sure to address them towards the end of the webinar. So without further ado, let's just get the ball rolling. I think we already completed the introduction, so we can move on to the first topic, which is a bit introductory also. And I'd like to talk for a moment on the difference between private and public blockchains. So there's the one note to make right at the beginning is the use of blockchain, which is a subtype of distributed ledger technology. And in a nutshell, it's a distributed ledger, distributed database in a peer-to-peer network in which every node has a copy of that ledger, and all updates to this ledger are collectively verified by the network to determine the new state of the ledger. And there are three notable properties of blockchains and indeed DLT to consider. So we begin with access control. Access control simply determines who can participate in the network. We have consensus algorithm, and this type of algorithm governs the process of verifying updates to the ledger and updating the state. And we also have the third property, centralization, and centralization describes the level of concentration of assets, resources, capabilities within a subset of network participants. And from the perspective of those three properties, let's look at the differences between public and private. So public blockchains are typically free to use, free in a way that they are democratic, and anyone can, in principle, participate in the network activity. But the implication of it is, because they're open, it's perfectly possible that some participants are going to be malicious, and therefore consensus algorithms must be Byzantine resistant. And some examples include proof of work like blockchain, or proof of stake like Ethereum quite recently. And decentralization is preferred because of risks inherent in concentrating assets and resources in honeypots in permissionless, potentially adversarial networks. Private blockchains are quite the opposite. Access is restricted, and resources are restricted also to a limited number of participants, typically from either one organization or a consortium of organizations. Because we're in a highly controlled environment, there's most of the time there's no need for very high Byzantine resistance, and therefore the consensus algorithm can leverage that trust in highly secure networks. An example consensus algorithm includes proof of authority. And obviously, the whole design is very much centralized, but in private blockchains, that's often preferred because it allows for an easier reconciliation and much more smoother network management. Moving on to the next slide and focusing on tokenization and tokenization of fiat currencies. So the process of tokenization involves taking an asset and representing this asset on a blockchain. And on the blockchain, what we're going to find is some shape and form of a ownership certificate that is cryptographically linked to the underlying asset, and the ownership can also be cryptographically verified. And because those assets are stored on the blockchain, the owners still remain full custody of the tokens. Of course, in order to be able to tokenize an asset, you do require infrastructure. And in case of real world assets, you also need physical, real world infrastructure to custody the assets your clients are depositing with you. It's quite critical because the tokens only have value if they're backed by the underlying assets. Otherwise, it's just diluting the value and printing money out of thin air. So typically, which is implicit process requires taking deposits of assets and minting digital token representations of those assets and transferring them to the original owners. Then the original owners are free to transact as if they were using the actual underlying asset. So in the example of fiat currency, the process requires the owners of fiat currency to deposit this currency, their asset, with the issuers. Then the issuer mints a corresponding amount of a token that represents this fiat currency, and then the users and the owners are free to go and transact. There can be other benefits added to tokenized assets, like, for example, instead of just storing fiat in bank accounts, issuers can go and buy government bills and bonds in order to earn yield on the collateral and then distribute this yield to the token holders. And one of the most prominent examples includes stable coins, Tether, USDC, and there's an important distinction to be made here. CBDCs are not tokenized for fiat. CBDCs are issued natively on blockchain, meaning there's no collateral there. And moving on, let's look at bridges. So what are blockchain bridges? So bridges allow us to transfer value and data across blockchains who have nothing in common at all. So they are quite simply heterogeneous. And there are multiple bridge architectures available depending on the underlying principle of how it operates. So we can come up with multiple categories. So I'll touch on some of them. One important distinction is trustless versus trusted. So trusted bridges, they do rely on some form of authority to enable their operations. For example, users must deposit their assets within a central authority. And trustless bridges, those are governed by algorithms and smart contracts, and there's no need for a trusted third party, or the role of a trusted third party is very much limited. Another classification can be based on the functionality of the bridge. So we have chain-to-chain bridges. Those connect to specific chains. We have multi-chain bridges who can connect different chains with each other, not just two. We have specialized bridges which serve only one purpose. We have wrapped asset bridges, which are just used to mint synthetic or tokenized, if you will, versions of assets on the source side to the destination side. We have data-specific bridges, which only deal in transacting data rather than value. And we also have DApp-specific bridges. Those are designed only to serve a particular decentralized application. If we're talking about value being transferred cross-chain, we can identify types like lock and mint, which derive their name from the fact that assets are locked on the source side and minted on the destination side. Another type is burn and mint. You burn assets on the source side and you mint them on the destination side. We also have atomic swaps, which are particularly interesting because they are fully anonymous or fully permissionless, and they can be used to swap funds between very heterogeneous networks without any involvement of any centralized party. And there are degrees of centralization as well, from fully centralized to fully permissionless. And speaking of risk, unfortunately, bridges are quite sensitive, as it turns out, to attacks. And to date, and based on our research, all bridge hacks represent 40% of all value lost in DeFi. And in other words, it amounts up to almost $3 billion as of 2024. Moving to custody. And the first question we should ask what even custody is, and in context of digital assets, that's a very broad term that includes various methods of storing and protecting digital assets on behalf of their owners. So, but there's a tricky part here, because the use of digital assets is only possible if there exists a corresponding private key or cryptographic material that will enable you to move those funds. When we're talking about digital assets in custody, in fact, what we mean by that is cryptographic material in custody, because we have a very direct link between the actual assets and the cryptographic material that protects those assets. Putting it very simply, whoever owns and controls the cryptographic material controls the assets as well. There are multiple ways custodians can go about protecting those assets, and we will look at some of them in the next slide. Focusing on key management and access controls, let's look at a couple of types of infrastructure in which keys can be stored. So we have we have 5 on this slide. So we have hot wallets. Hot wallets are this type of wallet that protects cryptographic material in an online environment, meaning you are able to interact with and transact with the wallet only by using some potentially even automated integration. There's no there's no external factor required. Everything is online. We have warm wallets, which are quite a step, I think, further in the direction of security, because they are just like hot wallets, although there is a second factor to approving transaction. Let's, for example, you get a notification on your iPhone, and you have to approve the transaction rather than just automatically executing a trade. Now, cold wallets, they are quite different. So for those in the audience who are familiar with air gaps and networking, cold wallet, that's the type of key management system that stores cryptographic material in an off-chain environment. So assuming everything that's connected to the internet is compromised, the cryptographic material remains safe. The downside is, however, it's quite awkward to use. And if you value low latency and retail volume of transactions, you might not be actually interested in cold wallets, because it does take time to physically take a device, plug it in, and effectuate a transaction. And now, going into slightly more advanced subjects, we have threshold signature schemes, and two examples we can identify are multi-signature and sharding. So multi-signature requires more than one signature, more than one cryptographic key to approve or effectuate a transaction, meaning, let's just say if you have three signers, even if two of them are entirely compromised, the funds are still safe because you need three to effectuate end transactions. And when we're talking about sharding, it's a bit like multi-signature, a bit like threshold signature schemes. It's just there is one key that's split into a number of shares, individual shares, and those shares on their own, they don't allow access, they don't control the funds. You need a quorum of those shards, just like you need a quorum of signatures in order to be able to produce a signature and effectuate a transaction. And threshold signature schemes can be implemented with any combination of hot, warm, and cold wallets. And moving on to something a bit mysterious, which is key ceremony. A ceremony is a scripted, highly controlled procedure of generating or provisioning secrets, and specifically in a key ceremony, cryptographic material that we need to access resources or assets is generated securely. And why do we need a highly controlled and scripted procedure? We need it because there's such an immediate access to digital assets with the cryptographic material. We could almost put an equality sign between these two. So we can't really speak of security of digital assets if we're not considering security of keys and the process of the generation. So ceremonies are trying to imitate protocols which are implemented in programming languages and within systems, but they extend the protocols to people, to humans, to us. So the goal of a ceremony is to describe the process in such a way so that humans can be thought of as computers, meaning humans, as almost like computers, they act on some input, they produce output, and they process this input in some way. So we can call it like almost like a state transition machine that produces outputs in response to inputs. So we are trying in a key ceremony to orchestrate and to choreograph the dance of all the people involved so that nobody can, for example, see or access a full secret, to prevent centralization, to prevent collusion, to prevent a number of unfortunate things that could happen. And because humans are typically quite difficult to model, a designer of a ceremony, they must take into consideration physical world, physical locations, human behavior, technology, geolocation, legal regime, a number of things that the IT people, they don't really concern themselves with. And as if that wasn't enough, you also need an external auditor. You do need some independent witness to attest that the ceremony was indeed executed according to the script. Otherwise, you could potentially be, suspected of just, going off script and not abiding by the rules you yourself wrote and established. So looking into secure transaction lifecycle, assuming we already created our keys securely, there are 5 stages. So we have payload creation, and payload creation is the process in which the transaction is actually defined, what the transaction is going to do. That's when it's being defined. And then the payload will find sender address, recipient address, will find the value that's being transacted, will find data that's being sent, and some metadata of the transaction. Then we move on to approval. The approval is a process of either manual or automated verification and screening of the transaction. And potentially you may have a number of people and then a number of hardware components looking at the transaction and clicking OK if they like it and clicking reject if they don't. Once we have the payload, once we have all the approvals, we send the transaction to what's called a transaction policy engine. So this component, it looks if the approvals match what's expected for a payload of that size and that type and this content, and it can either reject the transaction if the check fails, or if the check is successful, push the transaction further. That's a critical component of the entire infrastructure, because this will provide you with this will potentially provide features like AML, maybe KYC. It will look at the internals of who should approve and if those approvers are indeed expected. Once the policy check is happy, then we move on to signing. So we just take the cryptographic material that we created in a ceremony and we stored in one of wallets that we outlined previously, and we just sign the transaction. And there's a potential gotcha where a custodian stores multiple cryptographic keys. There's potentially what's called an attribution table. And this attribution table, quite simply maps user accounts to cryptographic keys. And it's important that the right cryptographic key is selected based on the transaction payload. And broadcasting, that's the process of submitting the transactions to a particular blockchain network. A transaction can be broadcasted internally by running a node on-prem and just sending the transaction to the node, or it can be transmitted through a third-party RPC provider, for example. And moving to the last, actually, slide in this transaction, we would like to move on to our discussion with Bank Frick. And what I'd like to do now is to talk to Dennis and Adam and find out what Bank Frick just did and accomplished in their DLT journey. So why don't we kick off with a quick intro of the bank for our audience? So Dennis, would you be so kind as to giving us a quick overview of, what is Bank Frick and, what are its origins, please?
Surely, I mean, Bank Frick in its root, it's a traditional private bank out of Liechtenstein. But the beauty about Bank Frick was since the beginning that they always were very opportunistic in the market. So they were looking, okay, how we basically can serve the future clients. That's when we basically got into crypto back in 2017 already. Being still in the game since 2017 might not be a long period when we compare it to traditional finance, but for crypto, it's actually a long way. So we have an expansive knowledge on how to deal with crypto clients, what is the risk appetite to bring them on board, and having a bunch of services out there which I'm more than happy to talk.
Good. Perfect. Thank you, Dennis. Speaking of, services that you guys offer, why don't we, look at the Pulse network that you guys put together? So, do you mind, like, giving us an overview of what Pulse is and, how does it fit into this whole blockchain thing?
Surely, I mean, Bank Frick in the market, like the branding, there is always like this perception about being a pioneer in blockchain banking. And Xpulse actually perfectly underlines that we are doing that and since the beginning. So basically, what is Xpulse? Xpulse is a 24/7 payment services where you can seamlessly within the Pulse network can transact fiat money from one counterparty to the other. That's basically in a nutshell what it is. We support the major fiat currencies out there, and due to the high volume, and I would say more like all the clients who are using yet Pulse or the huge demand on Pulse, we already expanded it to the second version. Second version includes as well cross-FX capabilities where you basically can come, for example, with US dollar, transfer it to a euro account, and this also seamlessly via API 24/7.
That's quite impressive. Thank you. So in terms of, integrations with blockchains, like does Pulse support most of the networks that are considered mainstream or common these days?
Well, yeah, I mean, from a Pulse perspective, I mean that's it will be a different layer where these transactions is. I mean, when we created Pulse, or basically to come into what is the benefit of Pulse at the end, the benefit was basically to serve all our audience or our clients, what we currently serve, but also like the future of the clients to be more efficient in the market. Maybe to have here a real world example, and I'm a huge believer always on this example because it makes it more feasible at the end. Let's assume you are a traditional asset manager. So you have a portfolio of equities, fixed income, maybe commodities. You were bound to the market like Monday till Friday, where you efficiently can operate. Your risk time to market was basically perfectly set back in the days. But now you want to go into crypto. So you think, okay, crypto is the next big thing. If you incorporate these asset classes to your traditional solution, what you have out there, you realize very quickly that you have a huge discrepancy on how the market is working, because crypto is not Monday till Friday, it's 24/7 up and running. So over the weekend, you didn't have the possibility to participate in the upside, but also on the downside. And this was basically the benefit which we saw. This has to be solved. And that's why we created Pulse, to be more efficient in the market, to doesn't matter in which time zones you are. So for example, if you are sitting in Indonesia, you have access to this network and can execute to all the counterparties within the network. Obviously, I mean, Pulse or the network itself, it sounds perfectly on the paper, but at the end, the flesh and the bone is basically the network itself, how many participants are in there. When we started with Pulse September last year, we had roughly 580 participants actively engaging on a daily basis. And now we are more than 600 FIs. And unfortunately, due to banking regulations, I cannot name all the clients who are participating on a daily basis in this network. But we have a good situation that we, for example, on our website, we listed some of our selected partners, which just gives you a bit an insight how institutional grade the clients are. And if you have a look on this website, you clearly see that the standard, what is out there, is highly professional. So you see the big exchanges want to go into this network and have this effect just from bringing clients, networking with the clients. And at the end, getting one network where everybody can participate in there. And that's the benefit of polls and how we also advertise it. I mean, if we come back just to the pure benefits, the pure benefits is basically, it is the uptime, as mentioned, 23/7. It doesn't cost you anything, so it's free of charge, all the transactions. That's why clients specifically need them, because it's not an additional fee layer, what we put on top. So you can really execute efficient or most efficient as possible. And then, yeah, obviously the network effect, what you had on the end, on the other hand. And this also then benefits, the network itself. The more participants are in the network, the stronger and robuster it gets. And also, if there are other networks out there and you have a good partnership with them, you can mix these connections, and then it makes it even more stronger. But in a nutshell, I think that's the most important thing about polls and how we move forward here.
Oh, that sounds amazing. It's like, bringing in, 21st century to, what otherwise, was stuck, like, at the, earlier life of financial market industry. So very happy to hear, all those initiatives, are going on. And, like speaking of, broader benefits of, partnering with Bank Frick, we have Adam, would potentially, show us and give us a taste of how what else Bank Frick is doing in the blockchain space. So Bank Frick are also into staking and restaking as well. So not definitely a common offering on the market. So Adam, like, would you like to dive in, be deeper, and give us an overview of how, like, what are Bank Frick's initiatives around that subject?
Sure, happy to do so. So taking into consideration that restaking is a very, very new concept, I need to do a little correction there. We're not offering restaking at the moment, but we do offer staking, institutional grade staking. I believe that most of you are already familiar with the term staking. Staking is technically the crypto equivalent of term deposits in the traditional finance sphere, if you're coming from the banking sphere, but interests are not guaranteed in the case of staking, of course. But technically, you have a coin on a proof of stake network, and you lock it in order to validate the network. That's the way how transactions are being validated. So if you lock your coins to do staking, you technically will be chosen at random from all the other stakers or validators on the network. But the more coins you have and the more coins you stake, the higher the chance that you will be chosen. So this is a very nice way to get your hands on some extra cash, which is super beneficial for like crypto ETFs, ETP and ETN issuers. You can kind of split like 50-30% of your underlying crypto and stake it and leave the rest for liquidity purposes, and in the meantime generate some extra yield to your clients. So this is a very hot topic. We already have a number of proof of stake chains where staking is enabled with vetted and trusted validators as service providers of Bank Frick. We have a lot of partners there, and it's already a very established service which multiple clients are using right now. But restaking, and just to mention it, it's all about the same staking, but do the double times. So it's kind of all about capital efficiency. You already have a staking position. Why don't you stake it again? Not just on the mainnet, but at the same time secure other protocols building on the mainnet. This is a very hot topic in the crypto space. More than like $10 billion worth of Ethereum is being restaked right now. And on Solana, there are also some initiatives, and we are having half an eye on it and taking a closer look at it, how you can natively do restaking or using your liquid stake tokens. That's also a thing. Most of the protocols accept liquid stake tokens like Lido Stake Sol, Lido Stake Ethereum, and then you can restake these tokens, which comes with elevated staking rewards on the one hand. On the other hand, also elevated staking risk, and you need 2 smart contract interactions. So that's why most of the regulated financial institutions are still hesitant to introduce this service only once it's battle tested.
Got it. Got it. So yeah, that's a number of benefits, and you touched on the risks as well. So do you like you might giving us a hint of what other risks might be there, and how Bank Frick is trying to mitigate those risks, or how they are addressed, so that the customers can be safe and just have the yield in mind, without being worried of their funds disappearing overnight.
Sure. So like I mentioned, we have trusted validated as a service provider partners. Most of them, they have slashing insurance against slashing, which happens when, for example, you as a validated service provider experience downtime, and the network kind of penalizes that by taking away part of your staking position. And this is something that we want to avoid at all costs. And that's why very secure and very established service providers have slashing insurance on top of the service. But other than that, Bank Frick is only interacting with whitelisted wallet and staking smart contract addresses. So nothing out of the blue, nothing into the ocean, just screened and closely monitored wallet and smart contract addresses. This is how we delegate the coins of our clients. So we have quite an extensive business compliance team doing that 24/7, and they are happy to do so in order to achieve highest security. So these are our countermeasures. But it's not just slashing risk that can occur when you stake. You also need to take into consideration the unstaking time period when you unblock a position of staking. And during that time, market movements, especially the ones that we are experiencing now, can cause significant price movements in the underlying crypto asset. So if you're staking, you also need to, and you intend to sell and have some liquidity in the underlying, you also need to take that into consideration. That's also a risk for the clients, but not the security one.
Got it. Got it. That's a fair point. And maybe to wrap up staking, Adam, do you mind giving a few examples of networks on which staking is available with Bank Frick?
Oh, sure. Right at the moment, we have Ethereum, Polygon, Solana, Cardano, Polkadot, Tezos, and Atom in the offering. But there are more and more chains in our asset universe to come. So we are expanding on a quarterly basis our portfolio.
Got it. Got it. Very cool. Very cool. But that leads me to a next question, actually, because you guys are dealing, in digital assets, and as we established in the presentation earlier, in order to be able to, to have digital assets under custody, you need, equipment, you need processes, you need like a whole, mini organization almost to be able to, do wonders with this blockchain thing. So another question, coming to you, and maybe I'll give a breathing break to Adam and ask Dennis. So Dennis, do you mind giving us a primer on digital assets custody as implemented in Bank Frick? Like, what infrastructure you guys have? How do you approach digital assets custody? You guys have been in the space for quite some time. You are well versed in traditional custody, but that's a new frontier. So it's very interesting to learn how you guys go about this whole thing.
Definitely, I think from a banking perspective, the bank itself was always, like, since day one, very eager to discover new opportunities. Custody is definitely one of them. But when we have offerings, and I think Adam mentioned it as well with the staking, we don't have all the options from the beginning. So the bank usually evaluates, okay, where's the risk appetite, what is stable in the market, and then going further with this. Coming back to the custody side, I think we started with custody already in 2018, so I've also built up their extensive of knowledge from this side. I think from this we have a lot of capabilities. What we can do a hot wallet, we can do cold wallet. The list goes on and on. Depends a bit on the client setup, what he at the end needs, because usually I'm more on the front-facing side, so where I discuss with the clients how the setup would look like, and then looking for example, with Adam, how the technical solution should happen. I mean, from just technical perspective, I think Adam, you have much more insights about what we recently changed on our side from the custody perspective. So if you can give here a bit insights what we recently changed, would be fantastic.
Sure. Just a few stuff around that. We have two custody technology services in place to achieve a very robust infrastructure. One is MPC based. The other one is AGSM based. MPC stands for multi-party computation, which kind of shards a private key into multiple pieces, and these key shares or key shards are stored multiple locations, geographically separated and encrypted, and therefore the private key of the client wallets never exists in one piece. So they are only brought together when a transaction is being signed. So this is how we kind of make sure that keys are not compromised in any level. And the other solution is the AGSM hardware security model based custody solution. That one is also enterprise and banking grade solution. And this is like a very specialized hardware equipment where keys are stored in an encrypted manner, and these are only active once a transaction needs to be signed. So it's like a super secure in cages, geographically separated with security stuff around it. These are very, very important measures that we have around custody. So it's not like back in the old world. Even though a lot of people call Bitcoin digital gold, we are not storing Bitcoin 40 feet underground in a vault under the bank's HQ. It's not like that on small ledger or Trezor stakes. That word is over. We have banking grade custody for that. And Piotr already pointed out accurately, it's all about storing the client's private keys. That's one leg. And also an important leg to mention, we need to replicate all of that on-chain data off-chain in our core banking system so that the clients can have an overview of the assets that they have. Otherwise, they wouldn't be able to check it. So this is also what a regulated financial institution needs to do, replicating on-chain data off-chain.
Got it. Got it. Yeah, very valuable insight, and definitely like the point on having basically parallel infrastructures for this extra redundancy, and providing obviously more security than otherwise a single platform setup would do. So it sounds like you guys have a very good thing going, and you have it going for quite some time now. And so, like from your perspective, right? Because I do think your point of view is valuable here. Like, arguably what many people in the industry are saying, we're observing now. We're observing a new digital transformation compared to moving to first from traditional systems to computer-based systems, then from computer-based system to cloud, and then there's this new thing called blockchain, which changes the paradigm of the internet almost. So you guys have been through potentially all those revolutions and transformations already. So as we are on the verge of this let's say fourth transformation now, what the Bank Frick advice from you guys, how to go about DLT transformation, like what the advice would be that you could give to institutions out there who are either trying to launch their own initiatives or to look for trusted partners, like what would your advice be?
I think if I may step in here, you have a lot of like from, for example, if you go to the big fives, you can go to McKinsey, ask these questions, and they give you a detailed plan like what you have to do, what you have to execute, etc. But I don't think that you have to go all these steps. It's actually very straightforward and very basic what you have to do if you want to implement this, and that's in a nutshell, listen to your clients, because that's basically how we started and how we got successful. We were listening to our clients, what are their pain points. We looked at the market, like how the market is evolving, and then coming both together, and then always be ready. I think if you have a software, or doesn't matter, your product is out there, you may serve the need for now for the market, but you always still have to continue. You have to learn, you have to develop, you have to make new decisions in which direction you are going. I think back in the days, and that's completely a different story, when we are looking, for example, at Nokia, they were once a top shot in the mobile industry, and now they are gone. And this just underlines a bit, okay, you really have to look to the market, where it's going, and not be shy to go new steps. It will be always difficult at the beginning, but at the end, it will be very rewarding. And I think this was one of the secret where Bank Frick was very good at it since the beginning. We had a perfect size about how many employees we were, and there we had a major benefit against the big competitors out there. So we can interact very smoothly. We can discuss, for example, Adam and myself, if we have an idea, we can discuss this. We have a very close connection to the board. We discuss it with the board, and if it's a feasible business case, we can implement this. If you go to a bigger company or a HSBC, just for example, implementing these steps takes not weeks, takes months, when not years. And I think just being agile, learning new things, also go the extra mile. I think that's the key, how to be successful in this game, and also going forward.
Got it.
If
So,
I
so
may
like
add to
basically it's
that,
easier to start small and just move fast, rather than waiting for the whole big machine to move.
If I may add to that, just one thought here. If you already know what your clients want, and if you discover that they want to have banking grade custody, they want to put limits buy orders on a very sophisticated execution venue to buy Bitcoin and other altcoins, and if they want to put that into a structured financial product that your financial institution, they want to calculate net asset value and so on and so forth, like a very sophisticated stack. Full disclosure, it's not just about Bank Frick, it's about all the other blockchain banks out there. If you want to start providing blockchain banking services to your clients, then the most straightforward way to do that is to go to a blockchain bank, open an account there, open an omnibus wallet there, and start using their services, so that you don't need to run your own nodes, you don't need to set up your own infrastructure, you don't need to have like a huge DevOps and LiveOps team and regulatory compliance team and operations team and so on and so forth, just to take account for the infrastructure maintenance and the development that the company needs. That it's it's easier if you go to an already existing blockchain bank, and luckily there are some already on the market.
Got it. Got it. Yeah. Okay. Cool. That's a very interesting point. So, like perhaps one interesting, maybe subject, especially to the Europeans out there, is the regulatory framework and the regulatory landscape, in the EU. So, potentially you guys also are interacting with a lot of customers from the EU as well. So, as far as regulation goes, do you mind sharing like maybe some of the concerns your clients may have, and how you try and address them, while offering blockchain based products? Because we do have Mica getting in a much more clearly defined shape, so to say. So regulation is coming. So the question is, like, what do we do with it? How do we get ready?
Surely, I think from our bank, like the core market is still Europe, where we are focused on, and then looking at, for example, Mica, that's a very good example. It always depends a bit who you're talking. So if you're talking with really like the crypto guys, like from day one who are in the game, etc., then it's maybe regulation not their favorite topic, to be honest. But if you're talking with institutional grade clients, the one who coming maybe from traditional finance, knowing all this regulation about Basel 1 to 3, etc., they are really happy with Mika coming into place. And I think it just depends a bit in which segment you are, where you're operating, what is your offering out there. I mean, for us as a bank, we are a licensed entity out of Liechtenstein. We have a banking license here, so we have to adhere to the license or to the regulator, what they say we have to do, obviously. And MiCA is just a standard which helps us at the end to be compliant with these regulations as well, to also promote the whole ecosystem in the EU to be more institutional grade, to be better and more efficient in this way. And I think and that's my personal view, I think Mika coming at the right time into place, and we can also play very well this card to have really institutional clients in the network who are knowing, okay, what is the risk associated, how to deal with the risk, and promoting just the whole infrastructure at a completely new level.
Got it. Perfect. Thank you so much, Dennis. Very, very valuable insight. Perfect. So I think we are about to wrap up our session. Thanks very much, guys. Thanks, Adam. Thanks, Dennis, for your insights. I think we all learned quite a lot in this session. So learning never stops. So for more resources, I'd be very much happy to refer you guys to halborn.com, where you can find our 100 DeFi hacks report and a couple of observations in the deck that we were presenting are coming from this very report. So you can get it by scanning the QR code on the screen. As Halborn, we also try and educate and reach to institutions out there. And one of the ways we go about it is with our annual event Access. And you can see the highlights and the talks from one of editions of Access when you open the QR code that you can see on the right side on the screen. And potentially there's more of those knowledge sharing slash webinars coming, and in order to provide better quality content to tailor it better to what you guys are interested in. We are very much interested in hearing your opinions, and to that end, we'll be sending out surveys towards the end of this webinar, and we very, very much appreciate if you guys wanted to share your opinions with us, because it just helps us create better quality content. And last but definitely not least, follow Bank Frick on socials, follow Halborn on socials. There's a lot of very interesting and valuable content coming out, and definitely don't recommend missing out on it. And with that said, I'm gonna turn over to Adam and Dennis for some closing thoughts, and it's gonna be a wrap up.
Thank you very much, Piotr. It was a pure pleasure. I mean, for myself, and I also can speak for Adam, having us on this webinar. And also from a Bank Frick perspective, we are more than happy if you follow us on LinkedIn. And yeah, really looking forward to, and maybe see one of you also on the next convention, which are going on. Thank you very much.
Thank you for having us.
Thank you, guys. Thanks so much, everybody. That's a wrap, and see you next time. Cheers.